Merry Christmas. Right now, silver looks calm, flat, almost frozen. The chart hasn't moved. Volatility is gone and the market feels like it has finally gone to sleep for the year. That calm is exactly what makes this moment dangerous. Markets don't go quiet when risk disappears. They go quiet when risk is being compressed. I'm recording this because tomorrow matters. December the 26th marks the start of a period professional traders understand instinctively but rarely explain openly. It's called Ghost Week. And if you don't know what Ghost Week really is, you're about to trade into one of the most fragile environments of the entire year. Ghost Week isn't just low volume, it's missing protection. The senior risk managers are gone, the big money desks are shut down. The deep pools of capital that normally absorb shocks and keep prices stable have vanished. What's left is a market running on autopilot, thin liquidity, and algorithms designed to keep the lights on, not to protect you. When liquidity disappears, markets stop behaving normally. Prices don't move smoothly. They jump, they gap. One order can do the damage of 100. The chart looks peaceful because nothing has happened yet, not because nothing can happen. Silver right now isn't resting. It's under pressure. Months of tension are packed into a market with very little depth. The most dangerous moment isn't panic, it's comfort. And comfort is exactly what this holiday silence creates. This calm isn't safety, it's the eye of the storm. In the next chapter, I'll explain how Ghost Week creates liquidity vacuums and why silver is uniquely vulnerable when that silence breaks. Subscribe if you want to stay ahead of the move, comment 1 to continue to chapter 2 or 2 to stop here. To understand why Ghost Week is so dangerous, you need to understand one concept that most retail traders never fully grasp. Liquidity is the market, not news, not indicators, not opinions. Liquidity. When liquidity is deep, markets forgive mistakes. When liquidity disappears, markets punish them instantly. On a normal trading week, silver is protected by layers of orders. Thousands of buyers and sellers stacked above and below the current price. If a large order hits the market, that depth absorbs the shock. Price might move a few cents, maybe $1, but it remains controlled. This is why people develop a false sense of security. They think the market is naturally stable. It isn't. It's artificially stabilized by participation. During Ghost Week, that participation vanishes. The senior desks flatten their books. The big funds step aside. What's left in the order book is a fraction of normal depth. 70, sometimes 90% of liquidity simply evaporates. The walls that normally hold price in place are quietly removed while everyone is distracted by holidays. This creates what professionals call a liquidity vacuum. In a vacuum, price doesn't travel. It falls or rises until it hits resistance, and if there is no resistance, it keeps going. That's how you get air pockets. That's how a market can drop $4 or jump $5 without any warning or follow-through logic. And this is where silver becomes uniquely dangerous. Silver is already a relatively thin market compared to equities or currencies. It doesn't take much capital to move it under normal conditions. During Ghost Week, it takes almost nothing. A single institutional rebalance, a hedge fund, covering exposure, or an algorithm reacting to a headline can push price levels that would normally be impossible. This is why traders who rely on tight stops and leverage get wiped out during holiday weeks. The market doesn't trend against them. It simply jumps over their risk controls. Their stop doesn't protect them because price never trades there. Ghost Week is when markets reveal their true structure. No padding, no shock absorbers, just raw order flow in an empty room. In the next chapter, we'll look at why this vacuum works, both directions, how gaps form, and why silver can move violently higher just as easily as it can flush lower. A liquidity vacuum doesn't choose direction. It doesn't care if the next move is up or down. It simply amplifies force. That's what most traders misunderstand. They assume danger only exists on the downside. In reality, the most violent damage often comes from upside moves that happen too fast to react to. In a normal market, price discovery is a conversation. Buyers push, sellers respond, and price negotiates its way higher or lower. During Ghost Week, that conversation stops. Sellers step away, buyers hesitate. And when one side finally acts, there is no one on the other side to slow the move down. This is how gaps are born, not because of excitement, but because of absence. If a large buy order enters a thin market, price doesn't climb tick by tick. It scans upward, searching for the first seller willing to transact. If there's no one at the next level, it keeps going. The result is a sudden jump that looks irrational on the chart, but is perfectly logical in the structure. Silver is especially vulnerable to this behavior. It sits at the intersection of industrial demand, monetary fear, and speculative positioning. That means it reacts to more triggers than most assets. A geopolitical headline, a currency move, a bond market shift. Any one of these can activate buying programs. And during Ghost Week, those programs don't meet resistance. They meet air. This is why traders wake up and feel like the market skipped levels overnight. It didn't skip them. Those levels simply never traded. There were no sellers there. The danger isn't just missing the move, it's being positioned against it with leverage when price gaps margin doesn't negotiate. Stops don't trigger where you expect. Accounts are closed before logic catches up. And here's the key point. Most people miss. Upside gaps create psychological damage. They force late entries, emotional decisions, and panic buying. That's how strong hands transfer risk to weak hands at the worst possible moment. In the next chapter, we'll connect this structure to history and show why holiday weeks have repeatedly been the launchpad for silver's most explosive moves. If Ghost Week sounds theoretical, history removes all doubt. Some of the most violent and trend-defining moves in silver did not begin during busy trading weeks or headline-filled sessions. They began when everyone assumed nothing would happen. Holidays, thin volume, empty desks. That's where the pattern reveals itself. Go back to Christmas 2010. Silver had already been rallying for months. Sentiment was stretched. Indicators were flashing overbought. Banks were telling clients to take profits before year-end. Most traders listened. They sold, shut down their screens, and went on vacation. During the quiet stretch between Christmas and New Year's, silver didn't crash. It drifted higher. Slowly at first, then with growing confidence. When traders returned in January, price was already beyond where they had exited. That quiet drift turned into panic chasing, and by April, silver was trading near $50. The launchpad wasn't the rally itself, it was the holiday silence. The same structure appeared again in December 2020. Markets were thin. Participation was low. Silver was recovering from a major shock earlier that year. During the holidays, positioning quietly shifted. Price began to creep higher without resistance. By January, gaps appeared. Momentum accelerated. What looked like a dead zone became the ignition point. This matters because markets don't repeat events. They repeat behavior. When liquidity vanishes and suppression mechanisms step away, silver naturally rises. It requires constant effort to hold it down. When that effort pauses, even briefly, price expresses its true direction. But today's setup is not a copy of 2010 or 2020. It's more dangerous. Back then, vaults were full. Inventories were deep. If price moved too far, banks could step in and absorb the move. Today, that buffer is thinner than it has ever been. History doesn't just warn us that Ghost Week matters, it warns us that when silver moves during holidays, it tends to set the tone for the entire year that follows. In the next chapter, we'll look at why this time is different. What has changed structurally and why inventory matters more now than at any point in modern history. The critical difference this time comes down to one word: inventory. In previous cycles, silver moved because of speculation. This cycle is moving because of scarcity. And that changes everything. When speculation drives a rally, it can be reversed. When scarcity drives it, control is lost. In past bull markets, vaults acted as shock absorbers. When price surged, metal flowed into storage as holders took profits. Supply increased, pressure eased, and the market could reset. That mechanism no longer functions the same way. Instead of metal flowing into vaults at higher prices, it is leaving them. And that is a structural warning most traders are not prepared to understand. When registered inventory drops during all-time highs, it signals something abnormal. It means buyers are not interested in price. They are interested in possession. These are not momentum traders or short-term speculators. These are entities securing supply because they no longer trust future availability. Once metal leaves the system, it cannot be rehypothecated. It cannot be used to cap price. It is gone. This creates what professionals call a hard floor. Not a technical support line, but a structural one. Price may dip briefly, even violently, but it cannot stay down because physical demand immediately absorbs it. Any sharp drop becomes an opportunity for those who missed allocation earlier. The market no longer asks whether silver is expensive. It asks whether silver is available. Now combine that with a ghost week. Liquidity is drying up at the same moment inventory is shrinking. That is an explosive mix. Dealers, market makers, and option writers rely on metal availability to hedge risk. When that metal disappears, their ability to control price collapses. They are forced to react instead of dictate. This is how feedback loops begin. Price rises, forcing hedging. Hedging pushes price higher, which forces more hedging. Without inventory, there is no release valve. The system feeds on itself. The danger for traders is misunderstanding the nature of pullbacks. A dip in this environment is not weakness. It is stress being redistributed. Those who sell out of fear often discover there is no re-entry. In the next chapter, we will connect this inventory stress to derivatives positioning and explain how gamma dynamics can turn a quiet market into a vertical move with no warning. When inventory tightens, the stress doesn't stay in the physical market. It migrates into derivatives, and that is where moves become violent. Futures and options are built on the assumption that supply exists somewhere in the background. When that assumption breaks, the paper market starts chasing a reality it can no longer control. Options dealers play a central role here. They sell call options believing they can hedge risk by buying futures if price rises. Under normal conditions, this works. There is liquidity, there is inventory, price moves gradually. But during Ghost Week, with thin order books and shrinking supply, that hedge becomes unstable. If silver pushes above key strike levels, dealers are forced to buy futures to stay neutral. That buying itself pushes price higher, triggering more hedging. This is what is known as a gamma squeeze. It is not driven by enthusiasm. It is driven by obligation. The market isn't choosing to go higher. It is being forced higher by its own structure. Now add low liquidity to that equation. Normally, hedging pressure is absorbed across many sellers. During Ghost Week, there are fewer sellers, so every forced buy order has an exaggerated impact. Price jumps instead of climbs. Each jump increases dealer exposure, requiring even more buying. This is why upside risk during holiday weeks is often underestimated. Traders are trained to fear crashes, not squeezes. But squeezes are far more destructive to poorly positioned accounts. They happen faster, they ignore logic, and they leave no exit. At the same time, algorithms amplify the effect. Many systems are programmed to respond to volatility expansion and new highs. When silver enters price discovery, those systems stop fading rallies and start chasing them. They don't evaluate value. They follow signals. And in a thin market, signal following becomes acceleration. What looks like excitement on a chart is often mechanical stress releasing. The market isn't celebrating, it is snapping. In the next chapter, we will examine why technical indicators like RSI fail in this environment, and why traders who rely on them often exit right before the most powerful leg higher. This is where many traders make their most expensive mistake. They see familiar indicators flashing warnings and assume the market must obey them. Overbought, extended, unsustainable. In a structurally stressed market, those signals lose their power. Indicators like RSI are designed for balanced conditions when buyers and sellers negotiate. But when liquidity is thin and supply is tight, markets stop negotiating. They move. An overbought reading doesn't signal exhaustion, it signals pressure. Silver has done this before. In every major bull run, RSI entered extreme territory early and stayed there far longer than traders expected. Those who sold or shorted based on indicators weren't cautious, they were positioned against structure. Right now, silver is in price discovery. There is no historical resistance above current levels. More importantly, there are no trapped sellers waiting to exit at break-even. Everyone is already in profit. That removes one of the main forces that normally slow markets down. When selling pressure disappears, pullbacks become shallow and recoveries become violent. The market doesn't wait for confirmation. It moves until something forces it to stop. Algorithms recognize this instantly. Once volatility expands and new highs form, breakout systems activate. They don't care if price looks expensive. They only respond to momentum and structure. And in a thin market, that response becomes acceleration. This is why relying on indicators during Ghost Week is dangerous. A pause looks like weakness, then price gaps higher before logic can react. In the next chapter, we will focus on survival. How to navigate Ghost Week without getting shaken out by volatility or destroyed by leverage. Ghost Week is not about prediction, it is about survival. Being right means nothing if your position cannot endure the volatility required to reach that outcome. This is where experience separates professionals from amateurs. When liquidity disappears, markets stop respecting precision. Tight stops, aggressive leverage, and short-term positioning become liabilities. Price can move several dollars in seconds, not because fundamentals changed, but because an order hit an empty book. These moves feel irrational, but structurally, they are completely normal in this environment. The most common mistake during Ghost Week is overconfidence. Traders see a strong narrative and assume they need maximum exposure. In reality, the stronger the setup, the less leverage you should use. Volatility is not a bug. It is the cost of participation. If your position cannot absorb it, you don't deserve the upside. This is the week when sudden spikes appear, sharp drops that last seconds then vanish. These are not trend reversals. They are liquidity events designed to clear weak hands. Over-leveraged traders get liquidated at the worst possible moment and then watch the market recover without them. The correct approach is restraint, smaller size, fewer trades, wider tolerance. This is not a week for scalping or precision entries. It is a week for letting structure unfold without interference. Ignore intraday noise. Watch behavior, not candles. Survive the chaos first. The real signal comes when full liquidity returns. In the next chapter, we will focus on January and how the first true trading session reveals whether this move is just noise or the beginning of something much larger. Holiday price action creates distortion. January delivers truth. This is when full liquidity returns and the market is forced to reveal whether Ghost Week was random noise or the start of a structural repricing. The first full trading session of the new year is critical. This is when hedge funds, banks, and large institutions log back in and reassess risk. If silver holds its gains or moves higher with real volume, that is confirmation. It tells you the move survived contact with serious capital and wasn't just a holiday anomaly. Many traders hesitate at this stage. They fear buying strength and wait for a perfect pullback. Strong markets rarely provide comfort. They pause briefly, then continue. A clean break above the Ghost Week range supported by volume is not exhaustion. It is acceptance. Volatility at the open does not mean failure. Early January often delivers a final shakeout. Weak hands, exit stops are cleared, and stronger players absorb supply. What matters is response. Does price recover quickly? Does buying pressure return without hesitation? Those answers matter more than any headline. This is also when fear turns into urgency. Managers who stayed cautious during the holidays suddenly face performance pressure. If silver is one of the few assets moving decisively, capital flows toward it out of necessity, not belief. January is not about prediction. It is about observation. Watch how dips are treated. Watch whether resistance fails instead of holds. That behavior tells you whether the market is preparing for continuation or exhaustion. In the final chapter, we will bring everything together and turn this setup into clear lessons and disciplined guidance for the months ahead. Everything we have discussed leads to one conclusion. This is not a normal market and it should not be treated like one. Ghost Week is not the event. It is the transition. It is the pressure chamber where structure is tested before direction is revealed. What matters now is not excitement, not fear, but discipline. The lesson is simple but unforgiving. Markets don't reward those who are right. They reward those who stay solvent long enough to be right. Scarcity, tightening inventory, structural demand, and shifting monetary policy all point in the same direction for silver. But the path between here and there will not be smooth. It will be volatile, emotional, and designed to shake conviction. This is where patience becomes an edge, not chasing strength, not panicking during sudden drops. Understanding that violent moves in thin conditions are not signals of failure, but symptoms of stress. When structure is strong, volatility is not the enemy. Leverage is. Another lesson is focus. Ignore the noise. Headlines will change daily. Price will whip. Commentators will flip narratives. What doesn't change is behavior. How quickly dips are bought. How price reacts to bad news. How little selling appears during stress. Those are the tells that matter. Most importantly, understand where you are in the cycle. Late-stage bull markets don't end quietly. They don't top when everyone is afraid. They top when scarcity turns into excess. We are not there yet. This phase is about recognition, repricing, and repositioning. If you take one thing from this series, let it be this. You don't need to predict every move. You need to respect structure, manage risk, and let time do the heavy lifting. The goal is not to trade every candle. The goal is to still be here when the real move unfolds. If this analysis helped you think more clearly about markets, risk, and timing, support the channel by liking, subscribing, and sharing it with others who want signal instead of noise. Drop a comment below with your thoughts and stay sharp. The next phase is coming, and preparation always beats reaction.